Hey everyone, this is a trader investor, and in this video I want to show you how I trade gaps in the SPY. SPY has gaps very regularly, but I want to show you how I capitalize on those gaps. And sometimes that happens in 10-15 minutes of the cash market opening. Sometimes it takes a little bit of time before it happens, but I'm going to show you the strategies that I implement to figure out where do I enter and where do I exit and what are some of the indications that I'm looking at. And because this is a day trading strategy, it could be done very quickly when the market opens at 6:30 a.m. Pacific time for me, and be done by 7:30. Or you could just monitor it throughout the day if you're so inclined to do so, or if you have time. So let me show you how the strategy works and what are some of my rules to trade this strategy. So the first thing I want to look at is day one to day two. I want to see a gap. So for example, here we didn't see a gap between the 12s and the 15s. We didn't see a gap, and I don't have extended hours showing, so gaps would very clearly be visible throughout the trading session, whatever time frame you want to look at. I'm going to start with the 5 minutes because I have a couple of rules around the 5 minutes before I jump into the 30 minutes. The 30 minutes, 1 hour really help you hone in on this, but the 5 minute, there's a rule that I use, and I'll show you how that rule applies. So when there's a gap, whether it's a gap up or a gap down, when there is a gap, the one thing I will look at is, will that gap fill, which it does a lot of the times, but maybe not necessarily that same trading day. It could happen over the next couple of days, or in some instances it could be weeks, months, years before that gap is filled. But what I'm interested in is what happens when there's a gap. What is the things that I look for that tell me it's okay to enter these gap entries? So here, just as an example, on March 12th, we had a gap down. So for me, before I enter, there are two things that I do. One, I draw the previous day's high and low. I take the previous day high, the previous day low. This is where I start. So rule number one, as price gaps, where did it gap in relation to previous day's high and low? As you can see, on this day, it gapped right at the previous day low. This for me is already a no entry because it doesn't show me enough strength. It just says this is a very strong support. It is coming down to the support, and there is no entry. If you want to be a little bit aggressive and want to take this trade, the one thing you could do is not on the 5 minutes. In this particular instance, you have to go to the 30 minutes. And what I want to see in the 30 minutes, so my charts just moved because I changed time. So here's the 19s, here's the 17s, the 11s, the 12s, right? So that's just because the charts have changed. I just wanted to capture those. So on the 11s, when I draw my support and resistance on the 11s, I already said price has come right down to that point, it opened right at that zone, right at the support from previous day. That's where it opened. So if I were to enter this trade as an aggressive trader, I want to see price test the gap open, right? This empty gap. I want it to fill that gap. However, on a 30-minute, show me a reversal candle, which is an inverted hammer. That's what I want to see here. If I see an inverted hammer at this place here, if I see this, I might enter it, knowing though that this is a very strong support. So again, as I said, for me this day was a no-go because it gapped right at a strong support from previous day. So let's go back to 5 minutes and find another day. I want to go back first, and we'll come forward as we're doing our analysis. So let's go back. We're going back here on the 18s. Let's take the 18s as an example. The 17s, the lows of the 17s were here. Here are the lows of the 17s, and here are the highs of the 17s. This is an inside day. I am not touching an inside day, right? I want price to open in this zone. This is where I want price to open for me to have a valid gap entry. If it doesn't open in that zone, this is no entry for me. This is an inside day. I skip this day. So then I move to the next day. So the next opportunity came on the 18s. And the 18s had a good gap because here's the low, here's the high. So I opened below that low. Fantastic. Now here's a setup, and here's my entry rule for this setup. For this setup on the 5-minute chart, this is my entry rule. This is, keep in mind, this is quick in and out. You know, make a couple $100 a contract on put options, call options in the first 30 minutes to an hour, and be done with your day trading. This could be somebody who has a regular 9-to-5 job. You go to your 9-to-5 job after this. Could be somebody who trades all day. You just are done the first hour and you go on about taking care of your family as a business for that day. So my rule is on the 5 minutes, the first 5 minutes open below the zone, which is great. The next 5 minutes has to close below the first 5 minutes for a down gap. If it's an up gap, it must close above the first 5 minutes. So on the third 5 minutes, meaning 10 minutes later, I enter at the open. And I'm not expecting price to move more than between $1 and $2 before I exit. If it moves beyond that before I exit, great. Here, 389 to 388, we've already hit that dollar move within that same 5-minute period. So, I can be done. And here's why I want just $1 or $2. Here's why I want that. I look at what are previous support and resistance. I look back here and I draw my support and resistance. I draw my support and resistance in that zone. And as soon as I get to my first you know, after the gap down, as soon as I get to my first support, I'm exiting, right? Because this is quick in, quick out, go on to your other business. So, and you know, you do 10, 20, 30 contracts, a dollar movement is significant, right? It's not something to ignore. And this can be done very, very quickly. So that's why I'm saying just a dollar or two, because when you're looking at these charts, 5, 15, 30-minute charts, there are some resistance support lines that come into the picture, and I don't want to be sitting there. As you can see this day, instead of capturing my, you know, $150 per contract, I'm in the negative, right? I don't want to be sitting through that. It moves a dollar. I'm not greedy. I take my profits and I am done for the day. This is a very fantastic trade. And you know, I'm not even considering, you know, the reversal, the gap fill. I'm just looking at what advantage can I take when there's this big gap that broke below the low or the high. There's a gap and then I enter. So then moving on to the next day, here. So here on the 23rd, what was the low of the 22nd? So the lows of the 22nd were up here. So I'll draw those. So this was the low. Actually the low was here. This was the low, this was the high. So price closed below the low, opened below the low. However, there's no entry for me, because on the next 5 minutes, price actually reversed instead of closing below the low of this bar. So there's no entry for me. This setup is done. Next opportunity on the 24th, price did not open above the recent highs. Therefore, this is an inside bar. When you're looking at a bigger time frame, I'm not entering this setup. Next one on the 25th, price, you can see clearly this was the low, this was the high. You can see clearly price opened there. I want to see on the 5 minutes that price has closed below the first 5 minutes bar. That did not happen. Then the next thing I want to look at, and I want to make sure this happens, and this is very, very critical, that low there, I want price to not enter in that zone. I want price to stay below the low of the previous day. If that happens, I look at the 30-minute chart, and just to make it easy for us to view, this is the day we want to look at. So when we change to 30 minutes, after the first 10 minutes, you're already switching to a 30-minute chart, because there's no more 5-minute chart to look at. We did not have the entry we were looking for during that time period. So after the first 10 minutes, you switch to a 30-minute chart. And what we want to see on the 30-minute chart, we want to see the 30-minute bar having a rejection at that resistance. So as you can see, it came very close to that resistance. It got rejected heavily, and it formed an inverted hammer. So at that inverted hammer, you take the very next open as a put position, and our expected move is between $1 and $2. So if it moves $1, so from 386 to 385, already the next 30 minutes that is happening. Once it moves $1, you want to make sure, where is that stopping? Why did it stop there? Why didn't it follow through very, very strongly? And what you want to see is, you know, looking left, where there are areas of resistance or support, or even if you want to draw it as a zone, you can see here in this zone, it acted as support, resistance, support a couple of times. So in this zone, in this zone here, price remained in that area. So as long as price remains in that zone, right about here, then I know it's time to exit. So it was $1 move was enough, we exit. Sometimes we get $2-3, great, but you know, $1 move is enough. You just have to manage your risk, upsize your contract size, but not without managing risk, because your stop loss is very, very tight. You can increase your contract size. I'll do some video on how to do risk management, how to calculate risk management, but as long as you're doing your risk management properly, you can upsize your contracts. And then here, $1 move is enough. $1 move, and it happened in 1 hour. 1 hour of trading, you are done for the day. And you're not even, you know, glued at the screen for 1 hour. You just have alerts. Here's my entry. I have an alert at the stop. I have an alert at the dollar. And I can do other things. And when I hear my alert, come back and say, okay, do I want to exit or not? And of course, my support zone, I've already drawn it before I enter the position. I have the line that tells me when to get in, what to expect for entry, whether it's on the downside or the upside. And I have this zone of potential support resistance already drawn before I execute this trade. And then, you know, first hour, this trade is done. So then we move on to the next day on March the 30th. And now we go back to our 5 minutes, because first 10 minutes is critical for our entry. So we go back to the 30th. On the 30th, we had a gap down, and that gap down below the low, and then 5 minutes later, this is where we entered, and then $1 move, 394.21, 393.21 is my dollar move, and it took a few minutes, but in less than an hour, we hit that spot again because it met our criteria. The low closed below the low. Now, this one you'll say it's a penny short from being the low of the previous bar. I consider this close enough, but it's up to your discretion. If you say, no, this is not close enough, I'll wait for 30 minutes, but that 30-minute signal level came and there was no entry. So that's okay there as well. And then next opportunity on the 31st, we had a gap up, and that gap up opened above the high of the previous day, above the 5 minute close, and here's our entry 396, and we're waiting for 397.22. That's our exit. So it has happened, you know, 322 somewhere about a couple of hours later, but we're monitoring that trend. That trend is working in our favor. We're monitoring it and we're in. So if that doesn't happen, the other thing is, if you have missed this entry, for example, you can see any pullback or any consolidation and say, I want to enter at the break of consolidation. That's also a valid entry, right? You have your stop here, and you know, try to see if there's a dollar move here. But because we're entering a bit further from the first 5 minutes, even if it's a 50 cents move or 60, 70 cents move, compared to your stop, this is significant reward. So that's why it's okay to also enter it at this level. So it's not about the perfecting the entry, but it's about perfecting the concept. We break the high, we break the low, That's when we enter. We don't enter anything outside of that. And here's a good example. On Friday, we opened above the highs. The first 5 minutes did not close, but even if you didn't switch to 30 minutes here, you see that price has respected this low. Price has respected this low, so you could say you want to enter at the break of this high. That's valid. Or, as I said in my rules, you can just say, hey, I switched to the 30 minutes. I'm switching to 30 minutes, and based on what the 30 minutes tell me, what their rejection, at the high of the previous day, there was no even attempt to go that low. There was no attempt to go for a pullback. So you could enter here on the 30 minutes at the break of the first 30 minutes, because there was no pullback. This was a very, very strong upward movement. I mentioned that 400 was something we could potentially reach during that this week. Today is not a trading day, so I knew by Thursday we had to reach it, and we reached it. And so I knew this was a strong day. This was a strong day. So our entry was the first 5 minute break or the first 30 minutes break, whichever one you feel comfortable with. That's our entry. And then we made our move from 399 to 400, right? That was our move. 398.83 to 399.83 is our dollar move, because 400 is a psychological number. 400 could act as a resistance, even though there was no, it's all-time high, so there's nothing to go back to say, is there some resistance? No, the resistance is that major psychological number. So we use that as a resistance to exit. So I just said, hey, $1 is enough. I'm not expecting $2 move on this one because of that resistance, and we call it a good day. So this is how you can easily trade gaps. There are other strategies that I will also go into and show you in the next few days. There are strategies on the reversal on the gap fill using Fibonacci, but this is just a very, very simple way. Don't look at any other indicator, except maybe you can look at volume and say, hey, when we had this down bar on the 31st, it was on heavy volume, but there was no follow through, right? Because the next day reversed, this down bar that had no follow through. It gives you some confidence that, okay, we're reversing course again, which was great. So this is how I traded. This is how I look at it. So happy trading, and we will analyze the markets for sure, how they closed, how we are preparing for the next week. I will do a market analysis video today or tomorrow and share that by Sunday. So happy trading, happy weekend, enjoy the long weekend, enjoy the Easter weekend, and happy Easter if you're celebrating it.